Welcome to Grow Money Business, the podcast dedicated to helping business owners grow both their wealth and business on their own terms. Here's your host, Grant Bledsoe.
Hello, everybody. Grant Bledsoe here. Welcome back to Grow Money Business. This week on the podcast, my guest is Dr. Laurence Kotlikoff. Larry Kotlikoff is an economist. He's currently a professor of economics at Boston University, but he's done a whole lot of stuff in his storied career. And to give you a little bit about his background, I'll read off some of the highlights from his resume. He's got a PhD in economics from Harvard, which he obtained back in the 70s. He's testified in front of Congress about 24 times. About 10 years ago, the Economist magazine named him one of the top 25 most influential economists in the world. He's published 19 different books. He's been quoted in numerous articles and published research papers. And I'm scrolling down the list here, and the total, I'm still scrolling, is greater than 650 times. Oh, and on top of that, he ran for president in 2016. He joined me today because he has a new book out called Money Magic, which is an economist's take on personal finances, and we really had a lovely conversation. We took about 60 minutes and talked about his book and his perspective on personal finance, which often flies in the face of conventional financial thinking and theories. And we talked about policies, the viability of Social Security and healthcare, and if he had an unlimited budget, what he would do with it in terms of presidential candidates in the upcoming election in 2024. So be sure to stick around until the end. This was honestly an honor to have Dr. Kotlikoff on the podcast, and he really shared some wonderful perspective on the state of things in our country and how he would suggest we all look at personal financial decisions. Hey everybody, real quick before we jump into today's episode, I have been advised by my attorneys to remind you all that none of what you might hear in today or any other episode of Grow Money Business is financial, investing, tax, legal, fitness, or even relationship advice. It's content that you're free to use and deploy on your own terms. And before you take any actions on what we might cover in the show, I really encourage you to consult with your accountant, attorney, or financial planner. If you don't have a financial planner and think that you might need one, be sure to check out threeoakswealth.com to learn more about my firm's planning, advice, and investment services. I am here this week with Larry Kotlikoff. Larry, welcome to the podcast. Thank you for taking the time to join me.
Oh, thanks so much for having me.
We're breaking some new ground today. You're recording from your car. You have great audio, which works just fine. I hope you're not in drive with your foot on the gas as we talk.
No, I'm in a rest stop here. I was mentioning to you, Grant, that I'm apologizing because I should be in an office, but I had to get back to Providence and ran into traffic. And anyway, here I am.
Well, it works just fine. Your audio sounds great. I could take the time and introduce you by reading your bio and CV and all that stuff, but it would take me 15 or 20 minutes because you've done quite a few things in your career. Would you mind introducing yourself and telling us what your career focus is at this point?
Yeah, so I'm a professor of economics at Boston University. I also have a software company. Our main tool is called Maxifi Planner, so it's at maxifi.com, maxifi.com, and so I work on personal finance. Just wrote a book called Money Magic that just came out about 10 days ago. It's about the economics approach to personal finance, and it's called Money Magic: An Economist's Secrets to More Money, Less Risk, and a Better Life. But that's just one of the things I work on. I've been working on carbon taxation of late, climate change. I've been wrote a book about fixing the banking system after the crash in 2008. I wrote a book about healthcare reform. I'm mostly a public finance and macroeconomist, so I've been working on economic models of growth and fiscal sustainability, and also tax design. So it's kind of like there's so many interesting topics in economics that, and I'm too young not to keep at it. So I just whatever is kind of like going on, I try and see if I can be of some help on that topic.
Well, you've written a lot about a lot of topics. I've been familiar with your name for a lot of years because I read your book on Social Security called Get What's Yours a long time ago, which is one of the more thorough explanations of the system, and I think beneficial to people who are expecting to claim benefits books around. So I'd certainly appreciate all you've done over the years, because I've directly benefited from it myself.
But
So
that book turned into a bestseller, a New York Times bestseller on Social Security. I mean, here it is. It's a book, about these rules, and it became a bestseller for like 11 months or something. Number one for like 10 days. Amazing.
I can't imagine what your pitch to the editors must have been like. You pick the driest subject with over 2,000 really complex and confusing rules, and then turn that into something people want to read. It's
It was wild. It's really surprising. Yeah.
So let's talk about the book that just came out. It's called Money Magic. I've read it, and as a financial planner, I really appreciated it because you have the perspective and framework of an economist. And the best way I can summarize it is that you take a look at personal financial decision making through the lens of consumption smoothing. Can you describe what that is and why we should care about it?
So consumption is like another word for living standard, what you get to spend. And so if you're a family, you might want to divide by the number of members in the household. So it's like the spending per household member, consumption per household member. And this is what economics views as our bottom line. Uh, we don't think that people really care about money just for the sake of having it. We really think most people care about money for reasons of spending, of consuming, of enjoying life, vacations, better restaurant meals, or food at home, better housing, uh, better video games, whatever it is that we enjoy. That's the kind of goal of accumulating money, and also making sure that you can spend it through time. You can have the same living standard through time, or something similar, pretty similar. That's the idea of consumption smoothing, having your living standard be stable. And so economics is focused on your living standard, but it's focused on basically four aspects of it. One is making it smooth through time, just like a squirrel is interested in having acorns for the winter, right? They're trying to smooth their consumption, their living standard. People are interested in smoothing their living standard across periods when they're working and periods when they're retired. So that's why we save for retirement. So that's the fundamental thing that we're up to. We're doing consumption smoothing when we save for retirement. And then we're also interested in trying to make our living standard as high as possible by getting the most out of, for example, Social Security. That's why the book was Get What Yours was such a big hit, was showing people how to maximize their lifetime benefits. But then also, how do you minimize your lifetime taxes? We have these these IRA and Roth accounts, and 401ks and SRAs and Keogh accounts, all these different retirement accounts that give us an opportunity really to cut our own taxes. And that's discussed, both Social Security and retirement accounts are discussed at length in this Money Magic book. But then there's other things like not overspending on housing, like turning that into an asset, living in a state where there's low taxes. There's a zillion different ways really to reduce uh, your taxes, raise your benefits, lower your off the top costs, expenses, and raise your living standard. And then the third thing is, how do you make decisions like, if is this house too expensive for me? You have to value that in terms of your living standard. How much will that cost me? Will it mean a 10% decline in my living standard the rest of my life? Or if I get married to Joe, I kind of like Frank better than Joe, but my living standard is going to be twice as high with Frank. Is it worth it? you know, and so there's a chapter called "Marry for Money," because money is a very important aspect of this decision. We can, if we like Frank and Joe equally well, and Frank makes more money, better marry Frank. What about getting divorced? Maybe I'm really miserable with Sue, but uh, she's like worth she's 12% of my living standard. If, if I was going to have if I could get divorced and not have my living standard drop by more than 12%, uh, I would do it. But if it means a 50% decline in my living standard, I'm gonna stick it out with Sue, and we are making these decisions. We're just not making them systematically. We are pricing lifestyle decisions based on our living standard without knowing the prices. It's like going to the grocery store, buying a cart full of groceries, and once the cart is filled up, your credit card is charged, but you have no idea what the prices are of what you've bought. So maybe you've ended up buying $500 worth of groceries, but not getting $500 worth of value because you bought things that were worth it cost more than you valued them, and then you didn't buy enough of things that were cheaper than you valued them. So that's the third thing, and the fourth thing is if you're investing your money at risk, you want to understand that how investing this way versus that way affects the variability of your living standard, the trajectories of your living standard. It's not that you're going to kind of do what conventional finance says, which is put your living standard on autopilot in retirement. You're going to set some target for here's what I want to spend. I'm going to spend it come hell or high water, and my investments better damn make sure that I can do that. And the probability of my making that is pretty high. And if not, I'm going to fail. My plan will fail, in which case I'll starve. But it's too bad I just done poorly. Uh, Well, that's not the way things work. I mean, what happens is that people adjust their spending all the time in light of what happens to their assets. If the market goes up a zillion% this year, I'm going to spend more. If it drops to nothing, I'm going to be cautious and reduce my spending. I'm not going to keep it on autopilot. So you need to see the trajectory of your living standard. You need to see how they spread out doing what are called Monte Carlo simulations. And so you can compare holding this portfolio with that portfolio. So understanding living standard risk is critically important. So these are the four things: consumption smoothing, raising the living standard safely. Before you start putting money in the stock market, figure out safe ways to raise your living standard, like maybe taking money out of your IRA to pay off your mortgage. That can be a big game winner in terms of just safely raising your living standard, and then pricing lifestyle decisions based on your living standard impact, and then your living standard risk analysis. Those are the four fundamentals of economic analysis of finance, personal finance.
It's an interesting perspective from someone in my seat who's been had drilled into them a certain way of thinking about personal finance for a long time. And I think I would guess that a lot of our listeners probably raised an eyebrow when you said, did he say take money out of my IRA to pay off the mortgage? And walk us through why that makes sense in some situations.
Well, so I gave the example in the book Money Magic about a 62-year-old who had been furloughed during COVID. So the household was in a low tax bracket. The safe return you can earn right now on the stock market, adjusted for inflation, is negative. That's the inflation index bonds, which are called TIPS, Treasury Inflation Protected Securities. Uh, they're the safest asset we have. Their yield is negative, and people are simultaneously putting money in stocks and also in TIPS. So uh, it's the risk-adjusted return on stock is really the TIPS. It's just like if you value the stocks on a risk-adjusted basis, it's uh, it's a return on TIPS which is negative. So stocks are extremely risky. They may seem like a great deal for sure thing, but they're not, and people know that, and that's why they're buying TIPS and why the return on TIPS is so low. If everybody thought stocks were really safe in the long run, which is a fallacy, no economist accepts that. It's a Wall Street view that's trying to get people to invest in securities that are going to generate fees for the investor, for the broker. But the reality is that these things are very risky. So when you risk adjust them, the return is negative. So if you're in a low tax bracket, then you want to pay your taxes on that IRA, on that taxable IRA, when you're in the low tax bracket. That's now, and not when you're in a higher tax bracket in the future. So that's an argument for taking the money out now. The second argument is that if the interest rate is negative, then if I just hold it, let's say I just hold it in cash, the money in cash, I'm going to lose because of inflation. I'm going to lose money. Why not just give it to Uncle Sam? Let him lose money, right? Why should I? In other words, if I owe $10,000, let's say I invested in tips, so that I know in today's dollars, in units of hot dogs, I'm going to end up with, let's say a hot dog was worth $1 today and cost $1 today. So I owe 10,000 hot dogs. 10 years from now, I'm going to end up, if I invest that 10,000, I'm going to only be able to buy 7,000 hot dogs, let's say. But I owe 10,000 in taxes. So it's better to pay them now, pay the taxes now, because if I'm just losing money by holding on to it on a safe basis. This obligation is perfectly safe, and I've got the ability to pay it off right now. It's not going to help me to safely lose money and then pay it off. Okay, so there's two reasons. One is low tax bracket, negative deferral. There's no deferral advantage now. It's negative. It used to be a positive deferral advantage. I could earn interest income inside the IRA and not have to pay taxes on it, and then take those tax savings and reinvest them. Right now, the the interest I'm earning is negative, so the deferral is reversed. So that's the second reason. And then the third reason is if I can take the money out, even if I have to pay taxes, what I have left after tax I can use to pay off a high interest debt like a mortgage. But even better would be a student loan. Maybe I'm paying 5-7% on that, or a credit card debt. Maybe it's 18%. So there's a clear arbitrage. So none of these three things involve risk. It's all low tax bracket, right? Uh, negative deferral, and getting the arbitrage on paying off a high interest loan. That's like investing at a high rate. So the safest investment these days is paying off high interest loans and obligations. That's a perfectly safe, uh, high yielding investment. So if you've got money in the stock market and you're paying 4% on a mortgage or 5-6% in on a student loan, and you think you're doing the right thing here, you're not. You're in effect borrowing money to invest it in the stock market. If you did the opposite, if you just took the money out of the market, paid off that, would you then the next day turn around and undo that? Would you go out and borrow at 6-7% in order to go put it in the stock market when the stock market's price earning ratio is 40 and it's averaging 20 historically? It's super high. You wouldn't do it.
Right.
So let's not let's not be irrational. Let's think about what you are doing. And so this makes perfect. And I showed that this particular example, this guy was making something like, I don't know, $75,000, absolutely safe. It's like a year's earning for this guy just by doing this little transaction of paying off his mortgage, which was a 30-year mortgage, a big number, big mortgage, uh, with the cashing out his IRA. He couldn't do better earning a negative return inside the IRA.
Right, right. And once you go that route, you're using tips. You're locking in your yield. The only way that that can't work out for you is if the U.S. government defaults. And as you put it, that's the safest investment that we can
Right.
think of really across the entire spectrum. And I think a lot of people think of, and even practitioners in the industry I talk to, the way you put it is there's this misconception that stocks are less risky over the long run, which is absolutely the wrong framing. A more prudent way, I would say, correct me if I'm wrong here, would be to say that you just have more capacity to take risk over a long-term period of time and recover from potential losses. It's not that it's any more or less risky. It's the same asset, right?
Yeah. If you absolutely, it's uh, the stocks evolve basically as random walks. There's if the stock market drops today, there's nothing that guarantees it's going to go back up. Or if it goes up today, there's nothing that guarantees it's going to go down again. But this is what Wall Street has been peddling, that stocks are safer in the long run. Let's bucket your investments into things that are safe in the short run, safe in the medium run, like intermediate bonds, medium term bonds, and safe in the long run, like stocks, which is not the case. The outcome on the stock, I don't know if you can see my hand, but if you just simulate Monte Carlo, the stock return, it's going to fan out. So the more of your portfolio you put into stocks, the more that cone of outcomes will tilt upwards. So there's going to be a higher probability of doing well, but also there's going to be more downside risk. Compared to investing in tips, let's say the tips were yielding nothing. So I have $100,000. I can insure myself that I'll always have $100,000, or I could take my $100,000, put half in stock and half in bonds. So yeah, on average, I'm going to do better 20 years from now. The stocks, this portfolio of 50-50 is going to have more than $100,000. Ignore inflation to keep this simple, but there's also going to be a higher probability of ending up with nothing in 20 years because the stocks can go to zero, or at least ending up with 50,000 rather than 100,000. So you can see that that's the nature of a random walk, which is what stocks. The reason that stocks evolve as a random walk, just to be clear, there is a kind of general. It's a random walk with a drift. There is a return, a basic underlying return, because corporations have some productivity, right? They have some capital, and that capital has earned some kind of average return. So it's a random walk with a trend. But let's leave apart the trend. The reason that stocks go up and down randomly is because there's new information coming into the market all the time, and that new information, by definition, is not predictable. It can be good information about the company, or bad information, or good information about the economy, or bad information. If we knew what it was going to be, it would already be reflected in the price of the security right now, in the price of the stock market right now, because people would be trading on that. So it's only new information that nobody knows will be good or bad, and that's why it's random. So that's a very interesting kind of thing about information. I don't know what I don't know, right?
Yeah.
Things that are, I can't. That's the definition of ignorance, and so new information is a shock, and it can be positive or negative.
Absolutely. In defense of stocks, when you put money into a stock or a group of stocks or an index fund or whatever, you are purchasing some portion of ownership for a corporation with a board of directors that has oversight over management, whose job it is to take in revenue, deliver some good or service to make money. You take out the expenses and there's profits left over, right? Which is the underlying return component that I suspect you're talking about. So
That's right.
there is something there, right? You have
Oh,
random information that nobody knows about if you're playing fairly, which we all should, of course, which will create that random walk. But you do have partial ownership in this money-making machine that is likely producing innate returns greater than tips, right? The risk is what happens to the price after you buy it.
absolutely. Yeah, there is a basic trend. This is not like going to the casino, like to Las Vegas, where your odds are that you're going to lose. Where the trend is negative. The longer you
Right.
stay in the building, the more likely it is you're going to walk out with nothing. The stock market has had yields about 6.5%, 7% above inflation on a long, on average. The problem is you can't play the averages. You're one
Right.
person, and when you need the money, the stock market might be, if you invested in 1929 and 1933, the stock market had dropped 86%. You invested in 2000, 2002 was down 50%. You invested in 2008, 2000 in middle of 2009, it was down 53%. So stocks can go down and not come back for a long time. So you do want to take advantage of this terrific machine, but you don't want to put your living standard at too much risk. So you need to
Right.
understand that living standard risk. And I discussed something called upside investing, which is a safe way for middle class people and poor people to be in the stock market um, without jeopardizing their underlying living standard. So let me maybe just quickly explain this. Uh, and so what I've been saying up till now is you want to kind of find safe ways to raise your living standard. So if I can arbitrage, pay off a high interest loan, a mortgage, for example, by taking money out of my IRA. So if I can get myself all the gains safely to my living standard, and then say, okay, now I want to build a floor to my living standard, and I'll put some money in the stock market, and maybe I'll add to it through time, but I'm going to treat that as money in the casino, in effect. I'm not going to spend out of it. I'm going to, otherwise, I'm going to invest in these TIPS, these inflation index bonds that are the safest investment, and build a floor to my living standard. And then uh, decide that once I leave the casino, maybe it's 60, between 60 and maybe 70, I'll take out first a tenth of this, the money in the stock market, whatever I have there in that account, maybe the next year a ninth, maybe the next year an eighth. As I do that, I can then take it, the money I withdraw, I invest again in TIPS, and now I can safely raise my floor to my living standard. So this is I don't know if you can see my hand here. You have this floor to your living standard, and then at some point at 60, it starts ratcheting up. And then when you've taken all the money out of the stock market that's left, that whatever that is, your floor is going to be permanently higher. So that's all upside risk. So this is a way to be in the market. So it's a combination not just of an investing scheme because you're investing in something in TIPS that are safe and stocks, but there's also a spending behavior here. It's I'm not going to spend out of something that I don't know is going to pay off. I'm not going to count on something that I don't know for sure will be there. So this is somebody who's very risk averse. They don't want their living standard to drop relative to the floor. They don't want to ever see their living standard decline relative to this, base living standard. But they do want to be in the market to take advantage of what you're referring to, Grant, which is this, wonderful productivity of American capital and global capital. And 40% of U.S. companies investment is abroad. So a lot of the return is coming from abroad that U.S. companies are generating. So, you're talking to somebody who does invest in stocks, but I'm not opposed to investing in stocks. I just want people to take, uh, you know, take harvest the low-hanging fruit before you start putting yourself at risk. And then if you are going to put money in the market, uh, don't put yourself at risk. Treat that money as lost until it's found,
Yeah.
and you take it out and convert it into something that's safe. It's like not buying. Suppose you're at the casino and you're at the roulette wheel, and you're starting to pile up a lot of chips, and you're doing well. Uh, so my advice is you don't at that point hop onto your computer and start buying maybe on Costco, buy a Lexus, sure that you're going to walk out of the casino making a fortune because you've made a fortune up to this point. Because if you keep playing in that casino, you could end up with a Lexus, owing the money on the Lexus, and broke. So I say
Yep.
don't buy anything until you leave the casino. Don't spend
Yeah.
out of the risky money until you've left.
Yeah, absolutely. And another way to characterize that might be build your financial plan around guaranteed investments first. Seal in your future living expenses using these risk-free tips that we're talking about. And then once you get there, additional savings go toward risk-free assets that are not going to jeopardize that future living standard if they go to zero. The
Risky asset.
downside, risky assets. Yeah, thank you. If they go to zero in the future. And from my perspective as a practitioner, I think it's a very sound approach. A lot of people across the country are not going to want to take that approach because it takes a lot more saving in order to get there when you don't have those greater returns that you might count on, even though we shouldn't because we haven't left the casino yet.
Yeah, I think people are, you know, sure that they're going to make a killing in the market. And I have talked to so many people that are saying, I'm sure you're going to get lots of angry uh, responses, emails saying, this guy's an idiot. I've made, I know how to play the market. I made a killing and I'm super rich. Well, if he's super rich, he probably wouldn't be listening to your podcast, right? He
Definitely not
probably
mine.
would be in Bali with servants and enjoying, I would hope. He can't be that rich. So he needs to be prudent and she. So, and also, as they say in the book, the richer you are, the more prudent you need to be because if you have, let's say, a Social Security benefit of 20,000 a year, and you have $100 in your checking account, in your brokerage account, that's it. Those are all your resources. Well, take the $100 and invest it in the riskiest thing possible, maybe a lottery ticket, the mega bucks, because your living standard is not at risk. If you lose all of it, all that $100, nothing's going to change your life. But if you have $20,000 in Social Security benefits and $100 million in assets, and you put that all into the megabucks, you could lose it all in one day, right?
Yeah.
If you put it on the stock market, it could go down in a few weeks by half. So the wealthier economics says that actually the rich people need to invest in bonds and the poor need to invest in stock, which is very counterintuitive. Now, the other thing people might say is, well, if I'm so rich, I can afford to lose $50 million. Uh, well, presumably that money is for your kids or your grandkids or your great grandkids, or maybe for charity you really are interested in helping other people. And you have to be the fiduciary for them. You can't put their welfare at risk either. So it's like you have to think about yourself as being alive forever through them and not jeopardize your future self. You have to be a fiduciary for your future self. And that's the other thing that too many of us kind of ignore. We think, well, the only person that's important is my current self. And, I'm 50. I'm not going to worry about being 80. I'm sure I'm not going to make it. That's another fallacy. And, uh, and what does that 80-year-old ever do? That 80-year-old isn't going to do anything for me. Why should I care about him? But it's me.
Yeah.
He's your child, in effect. You have to be concerned with that future self.
That's right. That's right. Changing topics just slightly. You had a really good chapter on Social Security, and I'm curious, after studying this stuff in depth for a long time. On the one hand, you make a really good argument that the Social Security benefits are almost ignored by a lot of people, and the decisions you make when filing for benefits are kind of tossed aside and under the rug for a lot of people, when it's in fact a huge portion of your finances in your retirement years. Juxtapose that with this ornate, complex system we have with over 2,000 rules, where your local Social Security, the employees at your local Social Security office are frequently giving people horrible advice, not to their own fault. It's a complicated thing. There's employees are underpaid. How do people make sound decisions here and wade through all this stuff? And I'm really putting the softball up on a tee for your books here, Larry.
Well, I would say, Money Magic has my 10 secrets, 10 top secrets for maximizing your lifetime benefits. And there are some cases where, and then Get What's Yours is the book all about Social Security. So if you want to become even more educated, you could get that book. And then there's software, which is this Maxifi.com program, which will figure out what to do on Social Security and help you, give you a game plan to maximize your lifetime benefits. And in some cases, you just can't figure it out without the software. For example, if you're a widow and you're 62 and you're trying to decide, should I take my widow's benefit first uh, or my Social Security, sorry, my widow's benefit first or my retirement benefit first, that decision you need to figure out by running the software. It's not something anybody can tell you the answer to without knowing the details of your earnings history. What you don't want to do, and what I talk about in Money Magic, is take both benefits at the same time, because you can screw yourself out of $200,000, that magnitude of money, if you do that. And I could get into how that happens, but I don't know if you want to get into all the details of that.
I would really like to skip those details for now, to be honest. Uh, what about this? What are your thoughts on the viability of the Social Security system in general? And every year, the trustees of the Social Security Trust are tasked with hiring actuaries to comment on how long the system is funded for. As I recall, the last report that came out said that we've got enough money in the Social Security Trust to fully fund benefits for the next 12 years through 2034, after which point something's going to have to change. What are your thoughts on the viability of Social Security in general, and what can we do to shore things up?
Well, the whole system is in terrible long-term financial shape. It's $59 trillion underwater in terms of its unfunded liability. If you take all the projections of the benefit outflows that the system has to pay to you, to our parents, to our kids out through the end of time as projected by Social Security, and then you subtract all the taxes that they're projected to get, and you also subtract off the trust fund, the difference is $59 trillion as reported in the trustees report that came out a few months ago. So it's hidden in table 6F1 in the trustees report because the politicians don't want us to know that the system is more than 2.5 years, basically 2.5 years of GDP underwater. And that's enormous. We need basically a 4 percentage point payroll tax hike immediately and permanently to deal with this liability. Have you heard any politician talk about $59 trillion of debt in Social Security? No. They talk about the official debt being 1 year of GDP, but this is 2.5 years of GDP. Then we've got obligations for Medicare and Medicaid and Obamacare and defense spending. The whole path of spending is way out of line with the path of revenues, according to the Congressional Budget Office. So we're the most insolvent of any developed country. And this is, I think, partly why we see inflation taking off. When inflation takes off, it's because people aren't being, people have extra money to spend because they're not being taxed that much. And that spending leads to higher prices. Now, one of the positive feedback loops here is that it lowers the real value, the value of hot dog, the value of the debt measured in terms of hot dogs. So the official debt is 1 year GDP. We made 7% of 1 year GDP by having inflation be 7%. Because if you own a treasury bond or a treasury bill, its purchasing power just went down 7% this year. You just got hit by a 7% tax in effect. So countries that are broke end up printing money to pay their bills. Our country's been doing that out the wazoo already, and prices rise. But it's not really going to be, we can't inflate our way out of this problem. Too many of our benefits are indexed to inflation, like Social Security. So you're asking me what I would do if I were like the Social Security czar. I would, uh, I would retire Social Security. I would I would freeze it in place, pay off the accrued benefits under the existing system. So, Grant, you, for example, would get your benefits when you hit retirement with zeros filled in your earnings record. You get everything we owe you up to this date. And then I would have everybody contribute into a personal security account system where the government would make matching contributions to help the poor, where if I'm contributing and my spouse isn't working, half of my contribution goes into her account, half goes in my account. And then everybody's invested by my laptop in the global financial markets. Everybody gets the same rate of return. Wall Street wouldn't get a penny of this. No fees, nothing goes through Wall Street. It just is directly invested by the government in the global market in an index fund. And then the government would guarantee that you're going to get back at least what you put in. Your account balance at retirement would equal what you put in adjusted for inflation. And then they would gradually sell off your account balance, buy inflation index bonds, use those bonds to pay you an annuity that's inflation protected, and other members of your cohort. They would annuitize the entire cohort that you're in, birth group, through the end of your days. So we'd move to a fully funded system from what we now have. Now, I'd also fix the healthcare system by going to Medicare Part Advantage for all. Bernie Sanders has been pushing for traditional Medicare for all. What we should do is go for the Republican version. Not that I'm a Republican, but the Republican version is better. It's Medicare Advantage for all, and that would provide a very competitive uh, system where everybody would have a policy and we'd have full insurance, universal insurance. And if you had a pre-existing condition, the insurance company you chose would get a bigger payment uh, based on your pre-existing condition. And through time, we could get our spending on healthcare down from 18% of GDP down to about 12 and get better performance. I mean, look at Switzerland, France, Germany, Israel. They're all spending less than 12% of GDP. We're spending 18%. We have worse outcomes than these other countries. So if we can go from 18 down to 12, then we can save the country. Then we can have the funds to pay off Social Security. Then we can have the funds to meet our Medicare obligations without going back, without bankrupting our kids. So, I ran for president back in 2016 as a write-in candidate, and I put together a platform, which is now a book on my website called You're Hired, and it lays out each of the policies that I would pursue if I were president, and each one has about 10 bullet points. So they're all simple policies. They're one-page policies, and they're policies I worked out talking to other economists. They're what economists think we should do. Economists are focused. We spend a lot of time working on how to fix things, and nobody knows about our answers because nobody asks us. Nobody and there's not a single there's not a single PhD economist in Congress. 535 members of Congress, I think. Not a single one of them has a PhD in economics. I don't know how many have a master's degree. Many were undergraduate majors, but that's not much. That's not real economics education.
They're
It's
all
not
lawyers. They're all lawyers, right?
lawyers, and Shakespeare said, "Go shoot the lawyers." First thing to do is shoot the lawyers.
Yeah.
I'm not advocating we shoot any member of Congress, God forbid, but lawyers, they're the ones who delivered Social Security into the morass it is. It's got 13 benefits, 2,728 rules in its handbook describing just 13 benefits, and hundreds of thousands of rules in its program operating manual system, uh, which are rules about those 2,728 rules. This thing could not be more complicated. This is the most complicated institution ever devised by man. And in New Zealand, as far as I know, they have a Social Security system with one rule. You reach 65, you get a check. It's the same check for everybody. That's it. One rule, not hundreds of thousands of rules that are designed to basically, like as catch-22s, screw you up.
Mhm.
So it's to the point where you need to buy a whole book to figure out what to do.
Right, right. We just covered a whole lot of ground. If it's okay with you, I'd like to back up and kind of dive into a couple of these concepts a little bit deeper. One of them, and you mentioned this in passing, is it's politically unpalatable to tax your way out of some of these deficits, whether it be the aggregate federal deficit or unfunded liabilities in Social Security. And from my perspective, again, correct me if I'm wrong here. I'm a novice in a lot of this stuff. It's a math problem. We have so much money coming in to the federal government through tax revenues. We have so much money coming out that we're spending, and we're spending a heck of a lot more than we're taking in each year, right? So we're adding to the pile of debt every single year. And when you look back across history, there are only a couple of ways that you can get out of that. You can raise taxes, bring in more revenue. You can shuffle around the economic policy, maybe stoke the economy to where there's more throughput through the same tax regime. You can spend less, right? And so far, each of these options are just horribly politically unpalatable. And as you put it, there's no politician alive that's going to suggest dramatically reducing spending, cutting defense budget in half or whatever. And nobody can figure out how to stoke the economy in a way that's permanently beneficial, which leaves us with the last option, that's printing our way out of the problem. Can that continue indefinitely? What is your take on how long we can continue running massive deficits? What's the end point?
Even if we deflated away, watered down all our official debt, we have all this unofficial debt that's inflation connected. Look, paying paying the military, we have to raise their wages in line with inflation. So those are real obligations. We can't get out from under that defense spending. We could cut defense spending. Maybe we should. But we do have, concerns with uh, China and Russia. I don't know if this is the time to be cutting defense spending, if we might be facing World War III in Europe. The but we have to rationalize our spending. We're not going to politically get taxes to go up by enough to deal with this problem. We can't morally indenture our children to the point, put such high taxes on them to the point that they want to leave the country. In Uruguay, they had such high taxes that 500,000 Uruguayans got up and left, many to Spain, and of course, then they ran into the Great Recession in Spain. So that wasn't very great. But what we have to do is rationalize our spending. We have to reform Social Security. We should reform the tax system so everybody has an incentive to work. Right now, we have so many benefit programs where if you earn money, if you're poor, I lose my food stamps, I lose my welfare payments, I lose my Medicaid, I lose my Obamacare subsidies. Uh, it's most 25% of the poor are in a 70% or higher marginal tax bracket. We're locking poor people into poverty generation after generation. So we have to fix the tax system so everybody has an incentive to work. We have to fix the transfer system so we don't penalize people if they do earn money. We have to get Social Security, uh, onto a sound footing where we, uh, retire the pay-go system and make it fully funded. We have to fix healthcare in a way where we can drop down the total spending and get everybody insured. So this can be done. And that's why I ran for president. And had everybody elected me, uh, we would be doing this right now. It's not anything that's on Biden's agenda. It's not anything that's on Republicans' agenda. But all these members of Congress and the president and the administration, they're all free to go to my website, kotlikoff.net, and download You're Hired. And they will come across, policy to fix healthcare. It's one page, 10 bullets, 10 bullets on Social Security, 10 bullets on the tax system, 10 bullets on fixing education. Think about education. We can have this Department of Education producing online educational content that can be used to provide, let's say, a half a day education throughout the country so the poorest school districts can get the best teachers in the country. And then the teachers they could have pods where the kids has a headset, not being distracted by other kids who might be unruly, and he's learning at his or her pace. If he doesn't pass the quiz, having been taught algebra this way, he'll get a different version of it from a different terrific teacher, and then the actual teacher will go around and be able to do one-on-one help. This is something They do this in Cuba. They teach kids with the best teachers on the television. They put the kids in front of a television screen. We should be doing this because rather than having kids not be reading up to grade level because they're in a class where maybe 10% of the kids are making things so disruptive that the other and it's also dangerous because nobody's kids are we can fix this. We can fix education so people actually get educated. This is a big problem in the country. We have an ever less educated society, and where people are believing fantasies left, right, and center about health, about vaccines, about you name it, about elections. We have judges left, right, and center saying this was a fair election. It was won by President Biden, and other people saying it was fraudulent. Well, we have to train people that evidence is evidence. It's not. If you're going to claim the opposite, you have to come forward with evidence. You can't make up your own science. You can't make up your own math. You can't make up your own elections. You can't do that. Not if you're an educated person. But we're becoming increasingly uneducated.
So everything you're describing, each of these policies across the spectrum is very logical and pragmatic from my perspective, from what you've laid out in the book. I've perused the website myself a little bit, everything you've just described. It's none of the stuff, no rational policy or few rational policies are policies we're getting from elected officials. Why is that? Why are we not getting anything, reasonable from the people who are actually in the seats? They're running their campaigns to get elected, not to come with, uncomfortable news that the constituents actually want to vote for. Why are we in this position? And then
Well, I think
I'd love to dive into your experience on the campaign trail and how that went too.
Well, I think we have, both party. The people that go out for the primaries are the truly, the extremists on both sides. They're the ones who show up in the middle of the week, whatever, to do a vote. Uh, and so the people running to get the nomination have to appeal to the extremes. And so then so the extremes have captured the two parties, both extremes. So I think what we really need is a third party that's going to capture the middle ground again, get us back to and we need several billionaires to put money behind a third party candidate. And when I ran, I thought the press would actually read the platform and talk about the platform and write about it. But they were just interested. Their first question was, "How much money do you have?" Had I been Bill Gates, they would have taken me seriously. I would have had a chance. I would have been probably on the in the debates, and then we would have not been discussing ridiculous things. I would have been discussing how to fix healthcare, so that everybody has a plan, everybody's covered, and we don't have cherry picking, and but we have competition, and we get and it's affordable, and we go from 18 down to 12% of GDP, and we do, it's not that much different than what my plan, what they do in Israel and France and Germany and Switzerland, where you know, and almost all the healthcare economists would agree with this plan. I mean, I talked to them. That's how I devised it. So we would have had an intelligent discussion. I think, short of a third party candidate, we're in big trouble. And I think the best we can do is find personal cover. And that's why I wrote the book Money Magic, so people can do as well as possible for themselves in the context of a country that's kind of falling apart.
So looking back on it now, you ran, what was it, 2012 or 2016 or both?
Around 2012, there was an online platform, kind of a third-party platform, but it fell apart after Mayor Bloomberg decided not to run. I think it was all set up for him to try and run, uh, and when he chose not to, suddenly nobody else was any good for this platform, and they just shut down, or they claimed
Uh,
they didn't have money. But in 2016, I actually was a registered candidate, which wasn't so easy. You have to, unless you're registered and get people to sign, petitions for you and pay some money, you don't get actually the ability to have your vote counted. But I was legally able to have my vote counted. I just didn't get any much press attention. Like the Boston Globe came to my apartment. And my cat was sitting at next to me, and our cat was sitting, and he's very cute. So they took a picture of the two of us, and they referred to the cat as my campaign director.
which is probably not what you're trying to portray, communicate.
Yeah, here's my. I was joking. Here's my campaign director right here, because I didn't have big headquarters. I was interested in the ideas, what because I think that's what we need, the way out, the exit ramp. How are we going to fix things? That's what we need to know. We all need to focus on that. We don't need to argue over conspiracy theories, and we need to have Josh Rogan put me on the tube and not uh, some nutbag talking about COVID, saying that he came up with mRNA, and he's got half the country convinced that these vaccines are dangerous and that we should take horse medicine they give to horses that's not been proven, or what is it, hydro, what is it, the
Chloroquine?
chloroquine, hydrochloroquine, Plaquenil,
Yeah,
yeah,
right,
yeah,
right, right.
which is not proven out. Uh, we have, you know, if there's anything I could leave people with here, is to say, uh, please get vaccinated, because it is just too dangerous for you not to. You have your family, your parents, your great grandkids. You got to take care of them, and you got to be there for them. And just don't. You got polio vaccine. You got all these other vaccines when you're a kid. Be be a man up, woman up, and you'll be a little bit under weather for a day, and just grin and bear it. The shot's not going to hurt you.
Well, let me ask you this. Let's say you have $5 billion sitting in an account devoted to the next to 2024 campaign. What are you, as Larry Kotlikoff, doing with that money? What happens next? How would you put those wheels in motion?
If I had that money to spend on the camp, if I knew exactly how I wanted to spend it, I would
Yeah,
make sure it was held safely. I buy tips to have that money for sure to spend on that camp. So if I have an obligation, I want to to pay it off. Like if I have a bond, an IOU, mortgage, student debt, I want to safely pay that off, get it out of the way, and then once I'm in a position where I have a living standard floor, then put some money into lottery tickets or the stock market, or even spend a little bit of money on the, $200 at Vegas, not 300, 200. Okay.
sure, sure,
The
sure. So, but before we get too off track, and I'm sorry for interrupting. My what the way I meant to ask the question was more if you had an unlimited pocketbook to devote to the next presidential election campaign, how would you deploy those funds? Not putting it in tips, limiting market risk, any of the above. What would you do? Would you just hand it over to a qualified person who can fund a third party candidate? Are you taking a more active role? What does that look like from your perspective?
Well, I think I would probably, if I really had an unlimited funds, I would try and set up a third party to with a really good candidate, and somebody with a lot of charisma. Not economists are not all that. I'm not all that charismatic, but some actually have, the right set of policies. Have to obviously have a primary, and he have to be chosen, and or she, and we'd have an option like Macron ran in France and set up his own party, uh, and became elected. We can do that here. So I don't know why there's not a billionaire who will come forward and say, "Look, I can do better. I made $1 billion running this company. I know how to run things. Choose me." Okay, and uh, let him be a writing candidate. Doesn't even have to set up a party. Just get on the ballot as a writing candidate and put in ads and make it clear how to spell his name, and he'll be elected or she'll be elected, and we will be better off. And then force the two parties to come together and say, look, if you don't vote for something reasonable, I'm going to call you out on it, and you're not helping the country. And we're here. The country chose me because you two are two quarreling kids who can't behave. Well, I'm here to knock your heads together and get something fixed. So maybe that's the way to go. So we could take, there's a lot. We have about 3,000 billionaires in this country. Let's get one of them to stand up and take over in the sense of giving us some leadership, not taking over in any military sense or anything like that. This is democracy, but join the democracy. If a college professor can get up there and put his name, you know, take the ridicule from his mother, 96. My mother calls me up when I first ran, calls me up and says, I've decided, after about a month or so I'm running, she said, I've decided to vote for you. And I said, great, Mom, that's terrific. And then 10 minutes later, she calls back. She says, Larry, I've decided to vote for you, but I'm afraid. I'm afraid. I said, why? I'm afraid about Obama. I'm afraid you're going to take votes away from him. I said, well, that's the idea. and she said, okay, I'll vote for you. But she ended up voting for Obama. She was in love with him. And I think he was a great president. Um, glad he did win. We needed him at the time. But right now, we don't need his policies. We don't need Trump's policies, and we don't need Biden's policies. We need economics policies.
That's very refreshing for someone like myself to hear. And if I had the connections to get you on Rogan with Elon Musk, maybe to talk him into funding a third party, I would. But unfortunately, I don't have those kind of connections. So I guess all we can do is keep spreading the message because it is completely reasonable and everything you laid out is very rational from my perspective. And I think that we're just completely missing that right now. So it's
Yeah, we're not having. Yeah.
well, I
Well,
really appreciate you. I cut you off, Larry. Go ahead.
I was just going to say, at least the next election, I'll be old enough to run. So
Yeah, they've kind of upped the threshold there, haven't they?
exactly. Yeah.
Well, I really appreciate you taking the time to come on. This is it was a very interesting book for me to read, and I really appreciate the chance to talk to you about some of this stuff. Um, tell everybody how they can follow you, where they can go to buy the book. Again, it's called Money Magic. Where can they get it?
Well, if you go to kotlikoff.net, you'll see you can click on Order Now, and then you'll see all the places that you can click on to go and buy it, whether it's Barnes & Noble, Amazon, Indie Bound, which are small bookstores. It'd be great if you could go to your local bookstore and order it, because we need to support the local bookstores. We need to have people go back and read, and we all need to keep educating ourselves. And then there's other articles and columns you'll find at kotlikoff.net. I'm writing about all kinds of things. And this morning I wrote a piece in Forbes, or yesterday, about how much money you can make these days by doing Roth conversions, because as I mentioned, the deferral is negative at this point, and it's a big deal for a lot of people, what they can make. So, and then we also have software, where there's links to the software, Maxifi.com, and there's a tool called Analyze My Divorce Settlement for people getting divorced. And then there's also a tool called Maximize My Social Security. If you're just focused on Social Security, it's $40. And definitely you want to run that before you go to Social Security and tell them what to do. Don't ask Social Security any questions. Just tell them, here's what I'm going to do, because they will tell you the wrong thing half the time.
I'm glad you mentioned that. I've run into that dozens of times in our practice with clients, and it's commonplace across the country.
Right.
Well, thank you again, my friend. Again, appreciate you coming on. For those of you out there listening, go check out Larry's book. I enjoyed it. He has some stuff to say in the book that probably flies in the face of what you think you believe about personal finance. And anytime we can challenge our thinking, I think that's beneficial.
Cool. Well, thanks so much, Grant, for having me. It's been a great pleasure.
It's all on my end. Thank you.
Thanks for tuning in to Grow Money Business, the podcast dedicated to helping business owners grow both their wealth and business on their own terms. Be sure to subscribe to the podcast on iTunes, Google Play, or wherever you digest podcasts to ensure you don't miss out on future episodes and announcements. And feel free to submit questions to growmoneybusiness.com.